Limited company or personal name for property investors. If you followed me for more than 5 minutes on social media, you've probably heard me speaking about this topic, but welcome to YouTube where we can unpack it a little bit more. So, what do you need to know when we're discussing whether we invest from a limited company or for personal name? Now, there are a lot of variables to consider. I'm going to cover them all in this video. Stick around to the end, but I'm going to give you the ideal scenario on how to move forward. So, in 2015, somebody called George Osborne, who you may be familiar with, came up with this incredible idea of introducing something called Section 24. Now, that was phased in subsequent years, and what that effectively meant was that landlords who owned property in their personal name were no longer able to offset the interest as an expense. Let's break that down very quickly and show you what I mean. If you had a property that you were renting out for £1,500 a month, that's the revenue coming in, and your mortgage was £1,000 a month, of course, ordinarily, you would expect that mortgage would come off as an expense and you would pay tax on any profit over and above that interest minus your other maintenance deductions and so on and so forth. But for simplicity's sake, let's just use it as £500 profit. So you would have paid tax on your £500. That would be the end of it and you'd move on. However, what's happening since the introduction of Section 24 is those that own property in their personal name are now paying tax on phantom profit. That's profit they never earned because they're not able to offset their mortgage as an expense. That means that £1,500 a month that they're bringing in, if £1,000 a month of it is towards a mortgage, they're still going to pay tax on the £1,500 a month. Yes, I know I'm putting aside any other allowable expenses for the time being for the sake of simplicity for this video. So, £1,500, if you're a higher rate taxpayer, means you're going to be paying 40% on £1,500, which means that you're going to be potentially paying £600 tax, even though you only, in real terms, actually made £500 profit. Yes, it's terrible. There is something called mortgage interest relief, which I would be remiss if I didn't put that in, which adds back 20%. So, what does that mean? Well, that means if you're a basic rate taxpayer, with mortgage interest relief accounted for, you're probably not actually in too detrimental of a position because you can add that back. However, when you start getting into the realms of higher rate and additional rate, which if you're not there, we should all be aiming to be there, income-wise at least, that means you're going to really be getting stung. And this is what's happened to a lot of landlords over time. You know, they've owned property in their personal name and they've gone from having this much at the end of the month to having this much at the end of the month while the tax man lines their pockets in the name of winning the vote. Sorry, who said that? Anyway, let's not get into the politics behind it. Let's stick to the facts. So Section 24, very, very damaging for somebody who owns property in their personal name. Yes, again, I will caveat that if you're a basic rate taxpayer, then it's not so detrimental. However, there are other things I'm going to mention in this video beyond Section 24, which are reasons why you might want to consider a limited company as a preferable option. Now, in the English Private Landlord Survey 2021, only 5% of properties, investment properties, were owned by a limited company structure. That's a scary statistic because 95% of people then are getting absolutely rinsed. Of course, it's more pertinent now than ever that we move forward with a limited company structure if you want to avoid Section 24. So number one reason for a limited company would be, of course, to avoid Section 24. Another reason would be for those who want to contribute into their pension. Now, using a pension is an incredible way to reduce your taxable income and to save money, quite frankly, and plan for a future. So let's say, for example, I want to contribute into my pension. I can contribute up to £60,000 a year. That means I take £60,000 from my limited company as an employer's contribution and put it into my personal pension entirely tax-free. But here's the kicker that a lot of people don't realize. If you own property in your personal name, you cannot do that because it is not classed as earned income. So pension contributions must be from earned income. In your personal name, when you have buy-to-let or property income on your self-assessment form, that is not income that you're able to actually make pension contributions from. There are some very minimal allowances, but depending on how that looks for you personally, it could be something like £3,600 a year or thereabouts, depending on some different factors. But that's worlds apart from £60,000 going into a pension, no questions asked. So pension-wise, much more tax efficient to be in a limited company structure. Great way to control your tax. Other videos on that. I won't go too deep down the pension rabbit hole right now. Then, of course, the other factor to consider is your liability. Now, there's a clue in the name limited company. And it's not the word company. So can you guess what it is? You guys are good. It's the word limited. It's limited because it's limited in its liability. What that means is if somebody wanted to sue that company for some reason, which it does happen, welcome to the world, your liability within that company is limited. So God forbids it all went horribly wrong. You could potentially fold that company and walk away into the sunset scot-free. Now, again, I'll caveat this. If you go around signing personal guarantees, then of course people have the ability to come after you. Generally speaking, most lenders in a limited company will ask you to sign a personal guarantee, which I'm absolutely fine with. That's secured against the premises. What I'm really talking about here is the threat of, let's say somebody falls down in your property and goes after you and sues you for X amount of money. That's when you would have the opportunity to potentially move, providing you've not done anything criminal where they could pierce the corporate vow, and I'm sure you wouldn't do, but then you could potentially walk away from the company without your personal assets being under threat. So limited liability, that's a major benefit that can't really be overstated to having a limited company. The next one is back onto tax, and we're talking about inheritance tax now. If you are looking to build a, now again, there's thresholds here. So if you've got one buy-to-let property that's worth 100 grand and your personal home that's worth 200 grand, that's great, but you don't really have an inheritance tax threat. So you don't need to worry about this so much. And if, assuming, by the way, your plan is not to go over the inheritance tax thresholds, fine. Maybe you want to stay in your personal name. You're a basic rate taxpayer. You're not planning to build your portfolio. You're not planning to make any money. You don't really care about wealth. You're just watching this video because it came up and you couldn't be bothered to change the channel. That's fine. Then maybe you stay in your personal name. However, if you're planning to build a property portfolio over time, which I assume most people that watch this channel are, and you're planning to be over the inheritance tax threshold, which for a married couple at the moment, if you include their primary residence, is in the region of £1 million or £500,000 per person. Now, what that means is if you've got over that, then you could be subject to, say, 40% inheritance tax. So I don't think you want to build a £10 million property portfolio to give £4 million of it away to HMRC when you die. You probably want to give that £4 million to your children. Some of you don't. That's fine. No judgment here. But majority of you will probably want to give that money to your children, which means you might want a limited company structured in the correct way so that you can allocate shares to your children and create a share structure that will mitigate or potentially eradicate inheritance tax. Now, again, beyond the scope of this video, other videos, plenty of other content on how you would go about creating that sort of structure. But I just want you to know that's a structure you can do with a limited company. It is not a structure you can do in your personal name. Liability, we spoke about. The next point that I'd like to cover is the control over your income. So if you're got property in your personal name, that generally goes through your self-assessment. So when you fill in your self-assessment, or your accountant does at the end of the year, you will put that under income from property. And what happens is it gets bundled in with all your other income. So your personal allowance has probably already been used up by your primary source of income, or unless you're a full-time investor with no other source of income. So your personal allowance will be used up, national insurance, it just gets thrown in the pot and goes on top of everything else that you're doing. You don't really have much control over how you realize that income. Whereas in a company, you've got the ability to say, well, I'm going to take this much as salary because that's the most tax efficient. I'll take this much as dividends. I'll keep this much in the company as retained profit. So you've got a lot more control over where you see the profit. And also you can spend from the company rather than take the money out, pay tax, and then spend it. And that's the very key difference, by the way. This syntax creates a very different outcome. So if you're in your personal name, You get money, pay tax, spend what's left. If you're in a limited company, obviously I'm generalizing and simplifying before you start trolling me, but if you're in a limited company, you make money, you spend money, and you pay tax on what's left. That creates a very different outcome in how much money you're left with at the end of the day. Get the right tax people in your power team, get the right support and help, and make sure the people that you get in your power team, especially tax professionals, actually invest in property. Not going to go off on a rant. I'm just going to leave that one right there. So corporation tax is between 19 to 25%, depending on the profitability of your company. For most people, it's going to be, that are £50,000 or under, it's going to be 19%. If you're 250K and over, you're going to pay 25% corporation tax. But again, if you pay salary out of your company, then you can offset the corporation tax, or you can extract as dividends and not have to pay the NI. Depending on your income, there's lots of different ways about that. The point really here is you're much more flexible by having that limited company in the first place. But what's the catch? There must be a catch. And a lot of people say to me, but you didn't mention this bit. Yes, that's because on social media, often I've got 60 to 90 seconds to summarize a topic. I'm hoping that you're not basing entire life decisions on a 60 to 90 second video. I'm hoping that you're using that as inspiration to go and find out more. But let's talk about some of the bits you need to be aware of, some of the considerations. Number one, but limited company mortgages are more expensive. True. Partly true. They're more expensive in the sense that you're often going to pay slightly more on the rate, but they're a lot more competitive than they've ever been. But that might mean you pay 0.5% more. Fine. It might mean in some cases you pay 1% more. About 0.5% to 1% is generally what you're going to see different between those two scenarios, a personal name and a limited company mortgage. The other thing that you do need to be aware of if you're having a limited company is compliance. You have to get your limited company accounts done and returns, and generally speaking, you'll need an accountant to do that, and that's going to come with a cost. So depending on the level of support that they're offering you and depending on the accountant, you might pay 600 quid a year. You might pay more if you're taking a bigger service. So you do have to factor that in. But personally, I think if you're doing this properly, if you're in property investment and you're trying to do something that makes you less than 50 quid a month, you're in the wrong place. So personally, for me, 50 quid a month to have an accountant do the books for a company, that's fine. If you're planning to not have more than 500,000 quid worth of assets, you're probably in the wrong place. If you're planning to earn a basic rate taxpayer, never cross the higher rate threshold, you're probably in the wrong place. So again, usually for most ambitious property investors, it's going to make more sense to be in a limited company structure. That's my humble opinion. That's my reasoning why. Let me know your thoughts in the comments. And of course, if you like this content, in fact, if you love this content, if you can't live without this content, or if you just want to show a bit of support to someone who's sat here taking their time to educate you free of charge, then please click the like, subscribe, and the bell icon to see more of this good stuff. And as always, you are very welcome.